However, all of this comes on the back of a really fantastic rally for the stock market over the last 4 weeks since the 9th of March. Seshadri Sen of Macquarie Research joins in to talk about whether this rally is durable from a fundamental perspective. Seshadri, morning. Thanks for joining in. How have you read this rally, and do you think it still has legs to it?
Well, in the short term, one would expect a pullback. In terms of the overall rally, our view has been for some time that in some ways the worst is over for the Indian economy. We are not expecting a massive recovery in a very short term, but in the medium term we do expect bottoming out of the economy, partly due to the massive interest rate cuts that have come through. So some of this rally certainly has been too much too soon. But the broad direction has certainly been along the lines that we have been expecting for some time.
If that is true, if the market does not climb significantly higher levels, can you say with some confidence that the chances of breaking below the previous lows appear thin?
Well, those are difficult calls to make, but I would be very surprised if previous lows are broken. As I've been saying for some time, the worst seems to be over for the economy, which doesn't mean that the problems are completely gone away, but that the October-December quarter probably represented the worst in many ways. So to that extent, given especially where valuations are, I'm not sure that we will significantly break the previous lows. You could never say maybe for a day or two for technical factors it could go to really low levels, but those would be one-offs. Broadly speaking, I think somewhere between 8.5 is clearly the bottom for the market. Probably the next low will be higher than the previous low. And the long-term and the medium-term direction, long-term it's always positive, but from a 12-month perspective, the direction does remain positive. So we clearly don't think that the previous lows will be significantly broken from hereafter.
Seshadri, morning. Where are valuations for you right now, though, at 10,000 plus? What kind of EPS targets do you have? Not for the year we close up, but more importantly for FY10.
Yeah, for FY10 we are at roughly 9.5 times 1 year forward. If you draw Sensex PE chart for previous 10-15 years, you'll see that 9 has been a very strong bottom a couple of times in the past, though this time it breached that significantly. The discussion, I must clarify, that comes in the wave of significant earnings uncertainty. So as per our current estimates, it's a 9.5. But there again, given where the economy is heading, we think that earnings uncertainty is much lower today than it was in the October-December quarter. So yeah, we're at 9.5. If we are wrong, maybe we are at probably 10. But it's still reasonably inexpensive from a historic perspective, especially given that interest rates are now significantly lower than it was 6 months ago.
What are you hearing at Macquarie about money flows or money interest, though, Seshadri? There's been a lot of talk about fund managers sitting with cash on the sidelines waiting to deploy it in the market. Is that interest still high, and can you see a lot of money getting into India specifically as a market? Some, yes, not, I don't think that there are massive flows. People are still sitting on cash. There were expectations of what was euphemistically called a panic rally, but I don't think that's about to happen, given that the economy will probably still deliver some bad news going forward. So I certainly wouldn't be chasing prices in this kind of an environment. The broad direction is upward, but it's not a secular upward rally. It will, every time the market runs up very significantly, as it did in the last 4 weeks, you would expect a pullback. So certainly some flows, but I don't think that we're seeing a flood of flows and looking at a massive liquidity-led rally. Also, I think the markets will be fairly discerning in terms of which stocks to buy, and will punish bad performance in financial terms fairly severely.
The one thing which has been worrying the markets, Seshadri, over the last 2 quarters at least, is the prospect of continuous earnings downgrades which kept coming. Analysts kept on lowering their numbers as the earnings were pretty bad. Do you think that might get arrested as we go beyond Q4, where the market has probably seen the worst in terms of earnings, and progressively every quarter earnings numbers don't need to be revised lower?
Oh, certainly. And we think that cycle saw its worst about 3 months ago. The downgrade cycle is definitely easing up, and the worst of the downgrade cycle, I would suspect, was somewhere between, say, August last year to December. So that's why when I say that 9.5 times doesn't look that expensive, it's because now compared to 3 months ago, the earnings visibility is much better, and the downgrade cycle we think is largely over. There still could be downgrades, but we don't think it will be to the extent that happened in the second half of 2008, calendar 2008.
How are you guys mapping the elections at Macquarie? Do you think it's a game-changing event for the stock market, or could cause temporary volatility but won't alter the basic undertone or the shape of the market?
The latter. It could cause temporary volatility. I think there's a lot of noise going around, but our view is that the ultimate outcome of the election is not going to be something that the market will be significantly spooked by. So yes, a lot of noise, a lot of investors will not invest till the elections are over and clarity emerges, but from medium-term perspective, it's certainly not a game changer.
What's the expectation from Infosys? Is full year guidance, Seshadri, easily the best performance in IT, outperformer amongst the market heavyweights?
We don't have that, and I'm anyway the strategist, so I don't really comment on individual stocks outside banks, which I cover directly.
What kind of tactical position are you all taking on some of the cyclicals now, though, Seshadri? Because some interest has come back, and many of these commodity-heavy stocks have actually led the pullback rally we've seen this past fortnight.
Well, we continue to be favorable towards cyclicals, but our bias is more towards domestic cyclicals than the commodity stocks. So, yes, the commodities have seen a pullback. We think that they probably will give up some of those gains in the short term as they are doing today. But our bias remains towards domestic cyclicals like auto, cement, banks, etc., rather than commodities.
As a strategist, what kind of a target are you setting out for the index 1 year out? And to play that kind of an up move that you're talking about, what would be the key overweights at Macquarie now?
Well, our medium-term target, 1 year target for the Sensex is a range of 10.5 to 11.5. So we pretty much reached that in April, which obviously raised the prospects of a pullback fairly significantly. Our key sectors that we're looking at are auto, cement, and banking. More cement and banking than auto. But probably all these sectors have run up quite a bit, and you probably expect a pullback in the short term.
Thanks, Seshadri, for joining in this morning with your thoughts. That's the Macquarie view on the markets and the target that they've set out.